Tim, it's great to have you here. Welcome. And where are you? So the decision was hawkish. The market's not sure if they should react that strongly to it. And where are we now?
Yeah, 15 handles down on the S&P off of where, we were very bullish coming into this is impressive given the dot plots did not give bulls what they should have wanted. 3-to-1 was more aggressive. The crew so far has analyzed this right on. And as you pointed out, maybe a lot more left to go with Powell, who at these pressers really can't help himself but be dovish. And then we'll wait for Fed officials over the next 2 to 3 weeks to try to unwind some of that. But the reality here is that the market is balancing it in real time, whereas, as you pointed out earlier, the Fed is certainly a lagging indicator. The story for the market, though, over the last few days has been the continued outperformance of semiconductors. They've outperformed the S&P by 20% since mid-April. The reemergence of Apple as leadership along with semis, this is a great backdrop for what's working to continue to work. Again, maybe a modest downtick in the economic outlook, but stability and a Fed on hold. This is great for a CapEx cycle in technology. It's great for companies that are growing. And it really does, I think, give the market some reason to continue to love what it's loved since that payroll number, which says the job market's balancing, but it's not falling apart.
So I was going to ask you, how do I trade around this decision? How do I trade around the words here? And I sense your answer from what you just said is do nothing. Sort of stick with what you got if it's working.
Well, there are places where I think you've also reaffirmed some trends that may be picking up some more steam. I think consumer discretionary still has headwinds. I think the consumer, and we have this bifurcation, but I think you're starting to see some, low on fumes, even in some of the, call it the higher demographics. I think if you look at some places where you've had interest rate sensitivity, I think the housing market and some of those trades, which are stratospheric again today, and I've been wrong on this for 6 months. So I just think you have a dynamic here where asset prices there, I think, could come under some pressure. But again, some of the discretionary parts of that housing trade, whether it would be in home furnishings, et cetera, that have been on fire, I would be cautious. I would be buying weakness in gold. I think gold, which gave up a lot of ground on Friday's payroll number, that the dynamics that had you wanting to own gold a week before that payroll number are very much still in play. We have a world and certainly a U.S. Where deficit spending is and essentially budget deficits are a thing of the future. And I think you want to buy some of those dynamics. Interesting, in terms of the bond market, and we've had a massive move. We had a massive move into this. I think there's a lot of investors, especially in the advisory community, that are looking to see where they can really push out duration on bonds, where they can be buying mid part of the curve, longer end of the curve. And is this the signal we've finally been waiting? You can look at rates all the way back to July of 2020. And in my view, it's a long trend, but it's still higher. But we're right at the bottom of that channel in a place where investors, I think, especially those that are looking to make allocation changes, want to own more duration in the bond market. It hasn't made sense to do it until now.
Yeah, it's been the anything but bonds bull market, as people have called it. And I think your point is interesting.